Abercrombie CEO set out a long-term goal of $5 billion in revenue. And if they achieve that, or even if they get close to that, this company is grossly undervalued today. And that's what we're going to dive into in this video. So guys, smash that like button and subscribe if you're new. You're watching More Money. Let's get it. What's up guys, and welcome back to the channel where the goal here is to help at least 1,000 people achieve financial independence much sooner. And this is a very interesting video because retail is generally a very tough business. I don't own any positions in any retailers at the moment, but there are some retailers that I feel as though are sort of like the baby being thrown out with the bathwater. Now, I'm not saying Abercrombie is one of those, but this is a very interesting opportunity to look at. So let's start with this here. Abercrombie stock was actually rising at the time when this video was made, and it was rising because the company is expecting revenues to be up to approximately $4.1 to $4.3 billion by the end of 2025, with operating margins at approximately 8%, or as they say, above 8%, which is huge. It's a very high operating margin goal, and it'd be wonderful if they hit it. But here's the main kicker. Longer term, the company believes that it can reach $5 billion in annual revenue and a sustainable operating margin at or above 10%. So if they're able to hit this, that would mean that the company is insanely undervalued right now. And I built out a whole operating model just to work this out and show you exactly what it looks like. And this is an operating model that the Patreons do get access to. And so let's go into it and I'll show it to you right here for free. And before we dive into it, let's just take a look here. They're saying that going forward, they're focused on maintaining their expense discipline and plan to see expense efficiencies while protecting and funding their sort of like always forward targets while generating significant cash flows. And so the way that they're going to do this is they're focusing on three principles, which is focused brand growth plans, accelerating the shift to digital, which means a lot because I think the guys that are strongest in this environment are the brands that have a pull of the customer through the retail channels, and finally operating with financial discipline. So to me, it looks like those last two strategic growth principles make a lot more sense to me. I don't see anyone who's not doing that, but hey, so long as they're focusing on it. Now, one analyst actually just recently downgraded the stock to neutral from buy, saying that inflation and a lack of stimulus could curb consumer demand in the short term. And that's actually what's causing so much pressure for these retailers' securities. However, the point that I want to make is I don't care if analysts see pressure in the short term. It doesn't matter if the company experiences pressure in the next 12 or even 24 months. What is the intrinsic value relative to its current share price as a company that's fundamentally operating into forever? And that's generally how I buy companies. But the best way to sort of gauge that is trying to understand what their long-term plan here is. And so here's their long-term plan. So you can see here, this is a slide from their investor presentation. They're saying that their 2025 targets are 3 to 5% sales growth off of 2022's figures, 8% plus operating margins, and $600 million of minimum cash flow generation between now and 2025. So that's sort of that's not their long-term targets, but that's their medium-term targets. And so how does this all look? Well, in the model that I give to the Patreons, this is sort of how I built it all out. You can see in 2022, there is expected growth weakness for revenues. You can see that revenues are not growing by 19% like they did in 2021. They're expected to grow at 1% into 2022. And by 2025, they're forecasting out sort of a recovery in the medium term. And so I forecasted out per management's guidance. So 4% in 2023, 4% in 2024, and 3% in 2025. And I just want to warn you guys that this may not actually pan out. They may not actually get to $4.1 billion or $4.2 billion of revenue by 2025 because there could potentially be a consumer-led weakness. However, note that the model goes out to 2031 because long-term, they're expecting a march to $5 billion in revenues with 10% operating margins. So I didn't give them the 10% operating margins. I actually gave them 9.5% operating profit margins, as you can see there. And also in the medium term, they're saying that their operating profit margins will be at least 8%. I'm just giving them 8%. I'm not giving them anything more than that. And now moving on to this next slide here, you can see that this is their cash flow statement. So this is part of the model that the Patreons get access to again, you can see that their buybacks are actually accelerating. They bought back almost $400 million of common stock in 2021. And my presumption is that if they expect to generate $600 million of free cash flow between now and 2025, a big chunk of that is going to be used to buy back securities, which, might I add, will be absolutely accretive, because buybacks in an environment where your share price is under pressure is probably the best thing that you can do. But a lot of people will note that a lot of retailers do go out of business when there's consumer-led recessions, because at the end of the day, there's nobody in the stores. And so the one thing you got to look at is, what does their capitalization picture look like? So you can see here that Abercrombie's capitalization picture is very healthy. They actually have $800 million of cash on hand and only $300 million of long-term debt. So they have $500 million of excess capital. So they're very over-collateralized, in my opinion, and that allows them to withstand consumer-led economic pressures that could occur with the retail market. And so what does my valuation look like? Well, you can see here with a terminal multiple of 12.5 times earnings, I'm valuing the company at approximately $62 per share. And what that reflects is the business is valued at approximately $54 per share, plus that excess cash is approximately $9 per share. So that's how we get to that $62 per share. And with their current share price at the time of this recording, which is approximately $18 per share, the share price as a percentage of the valuation is 29%. And moving on to the next slide, you can see that Abercrombie at the current share price is the second cheapest opportunity in the tracker that the Patreons get access to, because the share price as a percentage of their intrinsic value is approximately 30%. But there's one really important thing that I got to point out. The share price as a percentage of the intrinsic value is only one thing that you got to pay attention to. Generally, certain types of businesses have certain inherent risks built in, and you can see me explain that in the tracker that all the Patreons get access to. And so you can see here that I say here that retail is a tough business. And what do I mean? Well, look at the red boxes. So I'm saying that yes, it's a good sign that they have zero net debt, but I don't think that this is an inflationary resistant brand. I don't feel as though they have a strong economic moat. And the other thing is, how is the capital being treated by the management? Well, their share-based compensation is actually greater than 10% of free cash flow. So there are risks inherent to the business in itself, and there's a risk with respect to how much equity is being issued by management. And the other pressure that I do want to point out is that we're starting to see retail sales decline. So retail sales actually declined 0.3% in the month of May. And my presumption is that in the month of June, you're going to see retail sales decline even further. And I think we're now finally going to know that we're actually operating through a recession. Look, we had negative growth in Q1, and I absolutely believe that we're going to have negative growth in Q2. And so in other words, we're in a recession. And so the consumer is slowing down. This is going to put more downward pressure on Abercrombie shares as more and more people decide that they don't believe in management's growth expectations, in my opinion at least. Now, if you want access to any of the models that you saw here or the tracker, you can get access to that at the lower tier for the Patreons. And once again, like I always say, there's never any risk to you, because if you decide to sign up and then within the first month you decide, hey, I tried it, but it's not for me, no problem. Don't just cancel it. Message me in the Patreon app and let me know that you tried it out and it wasn't for you, and I'll fully refund your first month's subscription. So that means that there's zero risk to you. Now, the other thing that I do want to point out is that because I do feel that we're going to be entering into a recession, Jerome Powell actually recently announced or admitted that the policies of continuing to double the federal funds rate from where they are today to the end of the year could actually lead towards a recession. And so I actually covered all of that information in this video right here.